Welcome everyone to the Vested Interest channel. This is Shane, and in this video, we are going to cover the $920 I added in new capital to the portfolio, what positions I added to with those funds, any dividends I received, options I was in for the week, all the activity in the portfolio. I do this every Sunday, and if you are interested in that kind of content, go ahead and hit all of those buttons down below. Join us for this journey to financial freedom. Join the Vested Interest community. All right into the video. We're going to take a look at options first. We did have one options play that we were in this week hit. Johnson & Johnson covered call. One contract here, -1, stands for 100 shares. You must own 100 shares to do covered calls. And I sell covered calls or sell cash secured puts if I'm looking to get into a position or have some extra cash I want to utilize for options. But in this case, we did one covered call, sold the open here on Johnson & Johnson, ticker J&J, out of the healthcare sector with a September 5th, which was Friday, expiration date, $180 strike price, which means if it hit $180 or above, those 100 shares would be called away. Someone was willing to pay $180, and for that we received 45 cents per share minus some fees here, excuse me, which equals out to $44.47 in options premium. Now you can see here it expired on Friday, below the $180. So we kept the 100 shares and we roll the options premium into our portfolio. And we did add this. This was part of our weekly purchase cash here. And that is why I use options in the portfolio. Really look at some positions that have what I feel have run up maybe above their fair value. And then I run some options on them to try to generate some additional income to add back into the portfolio. A way to juice it up a little bit, create my own dividends, so to speak, and reinvest back into the portfolio overall. Not only were we successful in an options play this week, we also had quite a good week in dividends overall. We received some dividends on September 2nd, $287.88 total, broken up in these two companies here. Kroger, ticker KR, out of the consumer staple sector, paid us $36.15. We do have the DRIP set on the portfolio, so that stands for Dividend Reinvestment Plan, and that just basically means anytime a company pays us dividends in the portfolio, those funds automatically get reinvested right back into the same company. We don't have to do anything. The portfolio does that automatically for us. It's a way to keep that compounding going. So in this case, this $36.15 goes right back in and picks up 0.53099 more shares of Kroger. Pfizer also paid us dividends here, $251.73. Ticker PFE is out of the healthcare sector. And again, that $251.73 goes right back in and buys more shares of Pfizer. In this case, 10.10558 more shares of Pfizer. And as you can see, that is really starting to add up. I mean, every time Pfizer pays out now around 10 shares, 9 to 10 shares, and that will continue to grow. Now, I have been nibbling on this position as well, adding a share or two here and there to bring down my cost basis because it still is under my cost basis. But again, you can kind of see how that snowball is growing now, and that's what people are referring to. Whenever you hear compounded interest or the dividend snowball effect, this is what that looks like, right? We already own shares of Kroger and Pfizer. Those shares that we already own pay out dividends. Those dividends get reinvested, buy more shares, and then these shares will add additional passive income over the next calendar year. In this case, $18.12, right? So that's going to add to that snowball the next time these pay out. Even if I don't add to Pfizer or Kroger, it will generate more dividend income the next time they pay out. And we weren't done. On September 3rd, we also received dividends from Enbridge, ticker ENB, out of the energy sector, paid us $142.33. Again, with the DRIP set, those funds go right back in and pick up more shares. In this case, 2.96244 shares of Enbridge, which adds an additional $7.73 in passive income over the next calendar year. All right, now we will roll into the new capital added to the portfolio on September 2nd, which was Monday. Same day we went in and ran some options or tried to run some options with J&J being the one that hit. We added $446.91. With those funds, we added to our Comcast Corporation position, ticker CMCSA, out of the communications sector. Picked up those two shares at $33.80 per share. Added one more share to our Procter & Gamble position, ticker PG. This is out of the consumer staples sector. I think this gets us to 100 shares. We'll see that here towards the end. I believe we finally hit 100 shares here. Picked up that one share of Procter & Gamble at $157.92. and added 1 share to our Union Pacific Corporation position. Picked up that 1 share of UNP out of the industrial sector at $221.40. This is one I'm going to continue to add to throughout the month here, as well as Comcast. Procter & Gamble, it needs to be under about 160. I think it's run up a little bit, maybe just outside my buy price. But if it was to drop back into the 160 or under the 160 range, 155, 156, 157, where we've been buying it recently, I would like to add a little bit more there. But really, I'm going to be focusing on Union Pacific and Comcast and a couple others over the month of September here. The funds added and the new shares picked up added $12.38 in passive income over the next calendar year. Went back in on Friday. That should say September 5th. That would have been last week's buys. So September 5th here, we went back in on Friday and invested an additional $473.98. Part of that included the options premium that we received there for the Johnson & Johnson covered call. With those funds, we added 1 more share to our Pfizer position, picked up that 1 share at $24.69. Pfizer, again, is out of the healthcare sector. And then the next 3 buys are going to be our weekly buys. We did add 1 new position. I'll talk about that here in a minute. 2 shares of Schwab Strategic Dividend Growth ETF, ticker SCHD. Picked up those 2 shares at $27.77. The new position we added, Vanguard's International, everything outside of the United States stock market, VXUS. Picked up 1 share at $72.02. This is a new ETF added to the position, and this will become part of our weekly buys. And then 1 more share to our Vanguard Total Stock Market ETF, ticker VTI. Picked up that 1 share at $321.74. Now, my plan on VTI, I am going to continue to add to this one at least through the end of the year. Now, I'm not going to pull it out of the portfolio, but after the end of the year, I'll be over 100 shares in this position. It'll be one of the largest positions, if not the largest position in the portfolio. And I'm going to be a little more selective on this one whenever I purchase it. It may not be a weekly buy. It may be a, hey, it's pulled back a little bit, I'm going to buy it, or wait till it's under my cost basis for a little while as I build out VXUS, and I'll continue to add to SCHD. But again, VTI will probably not be a weekly buy. Maybe it turns into a bi-weekly buy, or like I said, just whenever it pulls back, I see a 5% drawdown or something like that. Definitely, if it drops below my cost basis, I'll continue to add to it. But it may not be a weekly buy, so there might be a little bit of a change at the end of the year. I'm going to continue to buy this one at least through the end of the year, maintain my weekly purchases on this one. But then, like I said, I may shift gears a little bit to build out VXUS while being selective on VTI. We'll see where the market stands at the end of the year before we make that decision. But that's something I've been thinking about, so I thought I'd share it. Now, the new shares added here with this $473.98 added an additional $9.39 in passive income over the next calendar year. Total invested $920.89. Total passive income added $47.62. Very nice to see the dividends roll in and the portfolio continue to compound over time. Running through the sector weights here, communications makes up 9.89% of the portfolio. Consumer discretionary is at 3.37% of the pie. Consumer staples at 8.51%. Energy makes up 9.55%. Financials is 6.58% of the overall portfolio. Healthcare is the largest slice of the pie at 16.8%. Industrials at 6.24%. Technology has roared back into second place. With the recent news around Google, Alphabet, winning their case with the government. So they're not going to have to break up. This one really shot up this week. So kind of like I said, roared back into second place here. Technology is at 14.36% of the portfolio. Utilities makes up materials makes up 2.29% of the portfolio. Utilities at 3.42%. REITs and real estate at 5.91%. And ETFs is in the third place position now after the recent run up in the information technology sector here at 13.06%. But eventually, ETFs will become the largest slice of the pie just by the nature of adding to those ETFs every single week. All right, here it is, the portfolio update. I do show this every single week. I think it's important for those of us in this space to be transparent about what we are investing in, how our portfolios are doing. So I show you my portfolio every Sunday so you can see a real portfolio built out over time, the ups and downs around holding a overall portfolio with different positions in it. and as well as individual positions, ups and downs as well. So hopefully, some of you out there maybe who are on the fence about starting your own portfolio don't think you can do it. Yes, you can. I am not a financial guru. You can certainly invest in the market on your own. You do not have to hire somebody to do it for you or pay fees for somebody to do it for you. If you don't know how to, pick individual stocks or find out how much a company is worth or something to do a discounted cash flow analysis or look at balance sheets or income statements, that's okay. You can stick with index funds or ETFs. Warren Buffett would recommend something that tracks the S&P 500, so something like FXAIX, which is an index fund, something like VOO, which is an ETF. Both of them track the S&P 500. There are lots of other ones out there that you could pick. I choose VTI, which tracks the overall stock market. Just added VXUS, which tracks the overall international stock market, and SCHD, which again is a dividend growth ETF. But there's other ones out there like SCHD, VYM, for example, is one. Some people like the technology stocks that are out there. Something like VGT or VUG are a couple that are out there that track large caps or tech. So there are different ETFs and index funds that you can track. Or that you could purchase and just invest in and not have to pick out individual stocks. So there are ways to invest in the market without looking at individual stocks. If that is something that you are interested in, I would suggest doing it as soon as possible. The earlier you start, the more time has to compound. That is your best friend. Time is going to pass anyway, right? We're all going to get a day older tomorrow, and that time's going to pass. 20 years from now, 20 years will have passed, and you can be either looking back thinking, man, I wish I would have been investing in the market, or you could be saying, wow, I've got 20 years in the market. That's the thing. Time is going to pass anyway, so you might as well use it to your advantage. Just like I said, pick an ETF or index fund that you are interested in. Again, Warren Buffett would recommend something that tracks the S&P 500, but there's other ones out there, and just whatever you can invest, $10 a week, $15 a week, $100 a week, $5 a week, whatever it is, or $100 a month, quarterly, yearly, whenever you get your taxes back. Whatever it is, be consistent. Make sure you're plugging that money away. Your future self will definitely thank you. All right, I'm going to get off that soapbox. Here are all the positions in this column in the portfolio. Total shares, everything will be as of the close of business on Friday as far as the updated numbers. Current stock price here, market value here, average share cost here, my purchase price, what I have into the position is here. This does include reinvested dividends. Total return, whether I'm up or down, you're going to see it. Obviously, if it's in the red, that means I'm down. Percent return, same thing. If it's in the red, that means I'm down. Green obviously means I'm up. Biggest winner still is AT&T. Looks like actually Kroger is in second place at 49%. Google right there with it at 49%. There's a good one to look at. Google, and I was buying this 3 or 4 months ago in the 150s whenever it pulled back. There was some issues around it. People were talking about Google search engine is dead. They're going to get broken up by the government. So much negative news. It dropped into the 150s, 160s. We just kept on buying it thinking, man, that's a really good price for this one. And now you can see it's up 49.2%. So that is really a good position to look at and show that when there's negative news, if the fundamentals of the company are still strong, revenue is still growing, margins are expanding, it's still growing as a business, which Google is, great fundamentals, great numbers overall, good balance sheet, good income statement, their debt's low, they're buying back shares, they're paying a dividend now, which they weren't before here a couple years back, which is why I didn't own them before. But when that negative news hits, and then you look at the fundamentals of the company, and the stock price really drops down and it's disconnected from the fundamentals of the company, those are the times to be buying. UNH is another one, right? Recently dropped as low as I think $240. We were about $236, whatever it was. We were buying it in the 270s. And now it's back up 15%. Same thing, very negative news around the company. CEO got shot. A bunch of other negative news around the company, government's investigating them, all of this. But then you look at the fundamentals and it looks pretty good. So those are the times, again, negative news, whatever's going on there, looking at the fundamentals. Just because the stock price goes down does not necessarily mean it is a time to sell. Same thing just because Comcast is in the negative right now. That's a position I'm continuing to add to. If I thought it was a good price at $38.45, it should be a better price at $33.91. So just because a company pulls back or there's negative news or something's going on doesn't mean it's a bad company if the fundamentals of the company are still sound. Like I said, profits are still expanding, revenue's growing, margins are expanding. Those are the times to be buying whenever that negative news hits and those stock prices get disconnected from the fundamentals. All right, let's keep going here. Sectors that each position falls in, whether they're quarterly, monthly, semi-annual payer, and what they pay, you'll see that here. I do have a couple updates here. Lam Research updated their dividend payout. So LRCX here, you'll see now is highlighted in yellow and now pays 26 cents. I think it was paying 24 cents per share before. You could go look up what exactly that raise was, but it was about a 4%. Is that what it was? LRCX, no, 13% raise. So very nice raise on that one, 13% raise. And then the other one that just announced its dividend raise was Vici. That's the 4%. Yeah, that one was 4%. Yeah, so that one went from, I think, 43 cents up to 45 cents. So we do have a couple of updated dividend payers here that updated their dividends recently. So we have those captured now. So the only thing we're waiting on still is LenB. OHI, I'm not really looking for a raise there. They haven't been raising their dividend recently. I don't expect that will change. I have not seen anything on them saying they're going to change that, but my yield is so high at 9.125% and I'm up 46%. So that's one I'm okay with the dividend not rising right now. I would like to see them begin that in the future. Hopefully we'll see that. AT&T again, if we're talking about this 2-3 years from now and they haven't raised their dividend, maybe it's a different story, but I bought them knowing they had just cut their dividend and they were focusing on paying down debt. Plus I'm up, like I said, 70% with a 6.4% dividend yield locked in. So I'm okay with that for now. But again, like I said, if we're talking about this 2-3 years from now and they're not talking about dividend raises, maybe we look at trimming that position. And then Verizon, still waiting on them to announce their dividend raise as well. All right, current yield of the positions here. My yield on cost for each individual position, as well as the totals at the bottom. Portfolio weighting. I do have a rule here in the portfolio weighting. I do not want any one position to be more than 10% of the portfolio. I do not want any one sector to be more than 20 to 25% of the portfolio. Now, I don't think I have any. Google's at 7.71%. Is that the largest? Nope, right here. UNH is at 7.81%. So those are the two largest positions. VTI is at 7.04%. What's SCHD? 6%. So nothing, and VTI, VXUS, and SCHD, I mean, those do not count. If they become more than 10% of the portfolio, so be it. I'm going to continue to add to those ones, like I said, on a pretty consistent basis. Maybe VTI goes to a biweekly or something like that after we get past the end of the year, but we'll wait and make that decision later. Estimated annual income from each position here, dividend growth year over year. I do adjust this as they adjust their dividend payouts. As you saw there with Lam Research, I think last year they were actually around a 14 or 15% raise, but still 13%. I'll take that. And then Vici at 4%, we just updated those. So you actually see it did drop down below 6%. It was a little bit above 6%. I think this one here, LRCX, was about 15%, I believe. So that did drop the overall dividend growth for the portfolio down a little bit, but that's okay. Payout months that they fall in here and 15% of a 52-week low. I use this column and I try to adjust these prices, you know, not every week, but at least bi-weekly or once a month. And I like to keep this cost above my average share cost. I want my average share cost to be below 15% of a 52-week low. That's why I use this column. Total shares currently 6,947.226 shares. Market value of the overall portfolio, $421,723.55. Purchase price, my cash out of pocket, which again does include reinvested dividends. So this is not technically just cash out of pocket. It does include reinvested dividends. But if I turned off the drip, that cash would go in my pocket. That's why I say it that way. $362,596.15. Total return, $59,127.40. I am up 16.31%. I do not focus on this. I say this every week. And the reason I don't focus on it, I know some people will tell you the only thing that matters is total return. I mean, to an extent, maybe that's true if you were looking to sell positions in the future. But I am not looking to sell positions in the future. I'm looking to hold the positions, collect the dividends in the future. So unless I sell out of all these positions, I do not lock in this total return. I don't lock in the return. So that's why I don't focus on it. It's fine if that's what you focus on. It's not my focus. Current yield, 3.08%. My yield on cost, 3.582%. And this is what I'm focused on. That's why it's circled over here in the red. The dividends paid out from all the different positions in the portfolio continues to grow week over week, month over month, year over year as I add new capital weekly, which I do, as the positions in the portfolio pay out dividends and those dividends get reinvested, and as they raise their dividend over time. And it currently sits at $12,987.26, very close to getting back over that $13,000 hump that we've been kind of stuck at for the last several months. I think we will get there next week. We'll have to wait and see, but I believe we will be back over 13,000 next week. Dividend growth year over year, you saw with those two adjustments there to Vici and Lam Research, did drop us down below 6% year over year dividend growth at 5.92%, but still nice to see that 5.92% dividend growth year over year. All right, well, that is really it for the portfolio update. I did get a recent picture of Outback. I think we're going to be closing the pool up here in a couple of weeks. But this is this morning's sunrise, Sunday morning's sunrise. So that is what I see out back behind my house every morning, which is nice. My wife talked me into buying a place on the lake, which I'll be honest, I could live without. I like the country, but she really likes it, and the view is nice. So that is this morning's sunrise. Hopefully you enjoy it. As always, appreciate you stopping by. If you haven't done so already, don't forget to show me some love. Hit that thumbs up, ring the notification bell. Most importantly, subscribe to the channel. Join us on this journey of financial freedom. Join the vested interest community. Drop a comment down below. Let me know what you think of the video. What is going on in your portfolio, more importantly? What are you buying? What are you adding to? Do you have any new positions that you have added? What ETFs are you in? Are you trimming any positions? I know some people are looking to take some profits, thinking that maybe we're looking at a pullback here. September is historically a down month for the overall market. And with some recent news, jobs report was not very good, to say the least. Actually, it was pretty bad, actually. And then the Fed is looking probably to cut rates, is what it sounds like. We'll have to wait and see. I think they're, in a couple weeks here, they're going to be back at it. We'll find out for sure. Now, cutting rates to me is not a good thing, right? It is like cheering for the ambulance coming because you just got shot, which is good because the ambulance is coming because you'll need them, but it doesn't help really with the bullet wound that you have. So if we have a big bullet wound in the economy, the ambulance coming doesn't fix the bullet wound, right? We need to fix what is causing the wound in the economy. And in my mind, in my opinion, that is the tariffs, the uncertainty around the tariffs, and some of the other economic policy that this current administration has is not doing very well. We are losing manufacturing jobs instead of gaining manufacturing jobs. Job growth overall has really declined significantly. I think we saw our first negative jobs month in June, which is not good. So rates are fine if you're looking to maybe purchase a house. Hopefully you can get that a little bit cheaper, or purchase a car or something like that. But a lot of times the Fed rate coming down does not impact our rates as much as it does the bank rates, which is really what the Fed rates is designed to cover. It's the amount of money that the banks borrow from each other. It doesn't really necessarily impact us as much as some people seem to think. And sometimes it has the negative effect on the overall market, actually. Sometimes it does just the opposite. People think the market's going to rally, and it does the opposite because the reason for the rate cuts spooks everyone, right? If the economy is not growing, the overall stock market is going to stagnate. That's just reality. All right. Let's wrap this one up. I do personally read and respond to the comments. I'm always interested to read your questions, opinions, or suggestions for future topics. So if you tune into the Stock Pick of the Day video series I do Monday through Thursday, and you have a company you'd like me to cover in that, drop it down below. And like I said, let me know what's going on in your portfolio. Let me know what you are doing in your investing journey. Would love to hear from you. And this is Shane signing off, wishing peace and prosperity to you and yours. And remember, financial security comes to those who take a vested interest. Hey, thanks for stopping by. Thanks for tuning in. Hope you have a great weekend, and we will see you in the next one. I'm not a financial advisor. Nothing in the presentation should be considered financial advice. I'm only sharing my opinion. Investing journey of educational and entertainment purposes. Investing involves risk. You can't lose money. You should never invest any amount you're not comfortable losing. Always do your own research. Invest based on your situation, circumstances, and select criteria, or see the advice and counsel of a certified financial advisor.